And you mentioned on your blog, you said, I'm a veteran of many markets, but couldn't make heads or tails of what I was seeing in the gold market. People told me the gold market was rigged, and initially I thought they were paranoid. And you said early on you dismissed the empirical observation and findings as merely coincidence, but it aroused your curiosity. So in addition to these physical shortages that you're describing and these premiums, there's been unnatural trading action as part of this as well, right?
Well, yeah. Listen, to give a little color to what you just read and to what I have posted in terms of historical documentation. My work life when I got out of university, I went to work for an institutional brokerage firm, and this institute and the markets that I started working in, I actually began in foreign exchange, and then I went into the interest rate arena, and specifically in interest rates, I went from Canadian money markets into U.S. money markets, which is the Eurodollar deposit market, and then into Eurodollar derivatives, which is U.S. dollar OTC swaps. And the instruments that fall under the umbrella of U.S. OTC swaps are FRAs, which we refer to as forward rate agreements or future rate agreements. That is a LIBOR-based product that trades OTC in the interbank market. And then in addition to that, interest rate swaps, which is maybe a little bit more complex an instrument than the FRA, but it involves an exchange of fixed for floating interest rates, and typically has a bond trade embedded in it if the tenor of the swap is between 3 and 10 years. And that's a bit of a mouthful, but what it equates to is my roughly 10-year working knowledge with those products, and interestingly, the particular 10 years that I worked in those products were basically the first 10 years from their creation, because these OTC swap products were by and large created and incubated in Toronto, Canada, and there's a long reason for that, and I've actually written about it as to why this occurred in Canada. And to put it into a very, very short summation, the reason why these off-balance sheet products were incubated in Canada is because back around 1980, when foreign banks were allowed to come into Canada and open up branch offices, they weren't given full branch status. They were when they changed the Bank Act allowing foreigners into the Canadian banking market, they deemed foreign banks to be called Schedule B banks. And what they did after lobbying by the existing large Canadian banks, they limited the amount of paid up capital that a foreign bank based in Canada could have. And what this meant was foreign banks that opened offices in Canada, when they opened their treasuries in Canada, their treasuries, because they had capital ceilings, and initially at around $5 million, they could not participate in typical treasury operations, as in playing the yield curve in the Eurodollar market, in the cash markets, borrowing and lending cash Eurodollars, because if they did that, they would have chewed up all their capital, and they would have had no room left on their balance sheet to do any corporate lending. And the whole notion behind letting these banks into Canada was that they would compete for corporate business. So the way it turned out, Canada, understand, had 5 domestic big banks, and we went from having roughly 5 or 6 domestic banks overnight to having 75 or 80. And that's what happened when we opened the floodgates in Canada and allowed foreign banks in to compete. And so what happens was you suddenly had 75 new banks in Canada. They all had treasuries, and for them to make money, they couldn't do so trading in the traditional sense. So what they did was they moved they basically invented or incubated new derivative products to simulate cash trading, but to do so off balance sheet to get around the limitation that was imposed on them with a capital ceiling. That's why these products were created here. That's why they were incubated here. And I can tell you for the first 10 years that these instruments existed, the biggest player, hands down, in the world was Citibank Canada Toronto. They were my account. They taught me the ins and outs, and they taught me my understanding of these products. And that's how I came to know what these products were and how they worked. And, I covered them as an account for the first 10 years that these instruments existed. And let's just say that since those days, the proliferation of these instruments has absolutely gone geometrically explosive. And the reason they have gone geometrically explosive is because people figured out that these instruments could be used to control. They weren't conceived as instruments to control. Just like a chainsaw wasn't a tool invented to cut somebody's arm off. But isn't it interesting how we have very macabre movies, Texas Chainsaw Massacres, that this instrument that was used to help facilitate the lumbering industry can be used in a very macabre way. Well, what I would like everybody to try and soak up out of this discussion or this explanation is that the intended use of these interest rate derivatives, which was intended to for the good, they've morphed and they're used in a very, very macabre way. And the American institutions that are using them in this fashion are the five, I call them the Magnificent Five, and these are all institutions with derivatives books ranging from 50 trillion in notional up to 75 trillion in notional, and those five names would include JP Morgan, the biggest, Bank of America, the second biggest, Citibank, I believe the third biggest at the moment, Goldman Sachs, the fourth biggest, and Morgan Stanley, the fifth biggest. And let me just say that the way these institutions are using these instruments, and when I say using them, they're using them when these institutions are captive users, because the real initiator of these products is actually the U.S. Treasury itself. And specifically within the U.S. Treasury, it's a very clandestine, very, very, very extremely well endowed branch of the U.S. Treasury, which does not publish financials, and it's called the Exchange Stabilization Fund. And the Exchange Stabilization Fund has been around since 1934. In 1934, the Exchange Stabilization Fund was created by an act of Congress, and it was funded with the proceeds from gold confiscation in 1934. And when gold was confiscated, I think it was confiscated initially at $20, and then it was almost overnight it was revalued at $35 or $40, and that created a windfall for the Treasury of really back in the day of around $3 billion. That $3 billion was seeded as seed capital for the Exchange Stabilization Fund. The Exchange Stabilization Fund has been operating above any law, without publishing any financials, and has grown from its initial seeding of $3 billion. And it's well documented. And for anybody who questions my discussion here about the Exchange Stabilization Fund, I direct you to marketskeptics.com. There's a brilliant expose done on the Exchange Stabilization Fund on that site. It's a video series. It's 5 10-minute YouTubes. I recommend anybody to go listen to it. And from there you'll learn just exactly what the Exchange Stabilization Fund, or the ESF, the activities that it's engaged in. Everything from nation building, arms trading, drug trading, murder for hire, and understand that this entity is accountable to nobody under any circumstances at any time, and they don't publish financials. So there you go. It's the Exchange Stabilization Fund, by the way, that initiates these interest rate derivative trades through their prime broker, who is the New York Federal Reserve. And the New York Federal Reserve acts as the broker for the Treasury and disseminates their orders to the Magnificent Five, the five banks, investment banks that I just mentioned previously. So that's a little bit of a mouthful for you there. I don't know if you have any follow-up on that.
Well, I guess one of the things for those who are listening, a lot of them are going to be newbies to this information, so a lot of that sounds fairly overwhelming, but can you give us some of the more most recent revelations in this area? You've kind of given us a history reaching back to the 1930s and so on, but what do you see as the most recent revelations that are occurring?
One actual appalling use of this derivatives brute force that I'd like to draw anybody who wants to listen to draw their attention to was everyone's heard about how LIBOR was allegedly rigged. Everybody has probably heard about how LIBOR was either broken or it's been fiddled with. And the first time that LIBOR was ever reported to be broken or there to be an issue with LIBOR. And when I say LIBOR, what I'm talking about is the LIBOR is spelled LIBOR. It stands for the London Interbank Offered Rate. And what the London Interbank Offered Rate is, it's a series of rates from 1 month out to 1 year, and it's supposed to represent where banks in London, reference banks in London, are willing to lend to their most creditworthy customers. And it's typically the offered side of the interbank Eurodollar money market rates. So if you have a 1 month LIBOR, for instance, of 7/8%, that would imply that a reference bank in London is willing to lend to a top credit in the interbank market at 7/8 of 1 percentage point. A 3-month Eurodollar deposit. A 1 month Eurodollar deposit on 1 month LIBOR. Then, of course, there would be a corresponding rate for the 3-month period. There would be a corresponding rate for the 6-month period, the 9-month period, and the 1 year period. So LIBOR is a reference term for where banks are willing to lend interbank or to their most creditworthy corporate customers. And so back in the third quarter of 2007 was the first time LIBOR was ever reported to be broken. And the reason why LIBOR was reported to be broken stemmed from the collapse of Bear Stearns in the spring of 2007. Bear Stearns collapsed because inside of Bear Stearns there were a couple of hedge funds that held a lot of subprime residential mortgage-backed securities. I think most people have heard of subprime, mortgage paper. And what caused the problem for Bear Stearns was that all of this subprime mortgage paper was all rated AAA. And you see, in credit markets, when Bear Stearns failed, they failed because this subprime mortgage paper, which was all rated AAA, it failed. I'm going to say it again. AAA rated paper failed. It was the first time in the history of credit markets that a AAA credit failed. That's really, really important. That's like saying the sun crashed into the earth. It's like saying something ridiculous. It's like saying 40 elephants ran through my living room this afternoon. In the history of credit markets, AAA had never failed.